share does not equal EBITDA, earnings before interest, taxes, depreciation, and amortization, and yet both calculations are used to evaluate companies, so it's important that we understand the differences because the numbers can be very different. And I'm going to use On Holdings, the company that makes running shoes, and their recent earnings announcement to explain this. So let's start off with some definitions. Earnings per share is earnings per common shareholder. So we take net income available to common shareholders, we subtract preferred dividends, divided by weighted average shares of common stock outstanding. So simple example, we have $1 million in net income, we subtract $40,000 in preferred dividends, that's the numerator, divided by 100,000 shares in the denominator, $9.60 is earnings per share. That's EPS. EBITDA, however, adds back 4 different items: interest expense, tax expense, depreciation, and amortization expense. Now, the thing here to realize is that some of these expenses are not cash items. Interest expense, you're generally paying cash for interest expense. However, with taxes, because of tax assets, tax liabilities, you may not write a check for all of the tax liability, the tax expense for that year. Complicated, but that's how that works. The 2 big ones, though, are depreciation expense, which is the decline in value of a physical asset, a truck, equipment, machinery. Amortization expense, the decline in value of an intangible asset like a patent, copyright, etc. These are non-cash items, so there's a little more justification in adding them back into the earnings calculation. So in OWN's case, On OWN holding company, their net income available to common shareholders was $135 million for the quarter that just ended. Their EBITDA was $273 million, which was slightly more than twice the net income available to common shareholders. So huge difference in the calculation, because keep in mind that even though interest, taxes, depreciation, and amortization are, some of that's non-cash, it is still an expense. It is still a cost you're incurring in your business. It still reduces the income statement. So you have to be very clear when you're looking at financial statements. Are you looking at earnings per share? Are you looking at EBITDA? You also have to be aware of what's GAAP accounting, what's non-GAAP accounting. So be aware of these important differences between these 2 calculations.